Hello guys, welcome to my channel. Today we are going to solve Cambridge AS and A Level MCQ paper. This is 2022 paper and this is paper 12 from May-June series. This is 1 hour long paper, so in our video it may take more than 1 hour, so I may split this video into 2 or 3 parts. Here, the first question says, which accounting concept states that revenue can be recorded after it has been earned? So there are 4 accounting concepts are given to you. First one is consistency, second one is going concern, third one is money measurement and realization. Consistency is following the same accounting principles every year. Going concern is business does not have closer plan in foreseeable future. Money measurement concept is all the things, all the account, all the transactions should be recorded in monetary terms in the accounts. And fourth one is realization, that revenue should be earned when it is realized and expenses should be recorded as soon as it is anticipated. So as per this, the correct option for your answer is realization, okay, because it says that accounting concept states that revenue can be recorded only when it is earned. Okay, so question number 2. A sole trader has changed the method of depreciating his machinery from reducing balance method in the year 1 to straight line method in year 2 of trading. The same percentage of depreciation is used in both cases. Okay, so first we were reducing balance method, and now from second years onwards it is a straight line method. So what is the effect on the net book value of machinery and the profit for year 2? So we know that as per the reducing balance method, if we charge depreciation, the amount of depreciation decreases every year. But in straight line method, the amount of depreciation remains same. So that means in year 2, the amount of depreciation will be more compared to reducing balance method if we apply straight line method. Okay, so if the amount of depreciation is more in year 2, then we can say that the net book value of the asset would be less or lower, okay, because the depreciation amount will be more in straight line method, okay, and the profit for the year will also be less because we are charging higher amount of depreciation. So the correct option is D here, lower net book value and lower profit for the year. Let's move on to the third one. Paul has a year end on 31st December. On 1st January 2020, he bought a non-current asset for 10,000. He sold it on 1st January 2021 for 8,500. Paul usually provides depreciation at the rate of 10% per annum. A full year depreciation is charged in the year of acquisition and none in the year of disposal. He forgot to provide for any depreciation on these assets. Okay, so right now this is the scenario that we have. On 1st January 2020, he bought non-current assets and he sold it on 1st January 2021. So he used it for 2020 and in 2021 he's selling it. His year ends on 31st December. He purchased it for 10,000. The cost is 10,000 here. And it did not say anything about the method of depreciation, but it does not matter because he has used it only for 1 year. So in this case, he provides the depreciation at 10% per annum. So the 10% of 10,000 every year would be 1,000. Okay. So that means the net book value at the end of 31st December 2020 or end of this year would be 9,000, which is 10,000 minus 1,000. Okay. And he is selling it for 8,500. So he purchased it for 10,000 and he sold it for 8,500, which means he is incurring loss of 1,500. This is what he will write in his income statement or statement of profit and loss. But he did not provide 10% depreciation, which he should have, because he forgot that. So that means his profit will be decreased by 1,000, which is 10% of 10,000. He should have decreased the depreciation in year 2020, but he did not provide 1,000 depreciation. That's why he is incurring loss of 1,500. So his profit will be lower by 1,000. Let's move on to the next question. A business depreciates its machine 10% per annum using straight line method on month by month basis, and business financial year ends on 30th June. Okay. So machine which had cost 6,600 on 1st April 2020 was sold on November 2021. The profit on the sales is 350. What was the sales proceed? If you get a question like this where the depreciation is on month to month basis, calculate the total number of month the assets is there in the business and find out the depreciation. Okay, so from 1st April 2020 to 30th November 2021. So let's do the calculation. In the month in 2020, it is from April to December, which is 9 months. And in 2021, we have used the asset from January to November, which is 11 months. So all together, use this asset for 20 months. Let's calculate the depreciation. As per the straight line method, the depreciation is 6,600 into rate, which is 10% divided by 100. So the amount of depreciation is 660 for 1 year. So that means for depreciation for 20 months should be this amount divided by 12 months into 20 months. Okay, so it is 1100. Amount of depreciation is 1100. We also know the cost of this asset is 6,000. Let's write it here. 6,600 is depreciation we just calculated here, which is 1100. So now the net book value is cost minus depreciation, which is 5,500. And we know the fact that we made a profit of 350 in this disposal. Okay. So that means we should have sold this asset at a price of 5,850 to make a profit of 350. So the answer is 5,850. Let's see that. 5,850. So this is our correct answer. Let's move on to the next question. Question number 5. Why does a business maintain sales and purchase ledger control account as a part of double entry system? Okay, we all have done sales and purchase ledger control account, and the question is, why do we do this? Okay, why do we keep it in our books of account? Options are: it allows a trial balance to be prepared easily from the nominal ledger account. Okay, so we prepare the control account so that it allows us to prepare trial balance easily from all the nominal account that we have. Okay, and then second one, it says it can involve separate employees, which makes more fraud more difficult. So second one is to check the fraud in the business, so that a who is maintaining the purchase account does not prepare purchase ledger control account or sales ledger control account. Okay, so it's totally another employee who is doing this. So Third option is there is no need to keep sales or purchase journal. That is untrue because we have to make sales and purchase journal. Those are the primary records. And fourth one, there is no need to reconcile with the personal account of customer and the supplier. No, even though we may prepare the control account, we have to make reconciliation on their personal account to know how much customer purchase from us and how much they have to pay us. Similarly, how much we bought from our supplier and what is the total amount we paid and how much is due. So that reconciliation needs to be done. So the options is only 1 and 2 is correct for sales and purchase ledger control account. So the correct answer is A. Okay, only 1 and 2. Next question, number 6. Dog received his business bank statement. He updated the cash book and prepared the bank reconciliation statement. Okay, so he received the bank statement and then he updated his cash book from that bank statement and prepare a reconciliation. Which items appear on the bank reconciliation statement? So when you prepare reconciliation, what do you write in bank reconciliation statement? Option A, bank charges. Does it appears in the statement? Number 1 is customer payment by direct debit. So when customer directly pays, do you write down that in the bank statement? And uncredited deposit. So when you deposit money in the bank, but bank hasn't credited that in your account, or do you write down that? Okay. So option A, bank charges, it says no, we do not write down that in the bank reconciliation statement because we update that in our cash book. So this is correct. Number 2, customer payments by direct debit. So customer is directly paying into our bank account, so we'll update that in our cash book. So this is also true. And last one is uncredited deposits. Okay, so when you deposit money but it is not credited, then you need to record that down in your bank statement. This is correct. So that means all 3 options are correct here for option A. So this is your right answer. Bank charges we write in the cash book. Customer directly paying in the bank also be recorded in the cash book. So this too will not appear in bank reconciliation statement. Uncredited deposits. So you deposited the money, you wrote that in your bank book, but it was not recorded in the bank statement. So we prepare a bank reconciliation and we record it there. I hope you understood this. Let's go to the next question, question number 7. At 31st December 2021, sales ledger control account had a balance of 19,100 while the total balance on the sales ledger were 20,900. The following reconciliation statement has been prepared after the error were located. Balance of sales ledger control account 19,100. Credit sales omitted from the sales journal 1,600 and the discount allowed understated in sales ledger is 200. So the total of sales balance is 20,900. Okay. What is the correct amount of trade receivables as shown in the statement of financial position? So we can see that here this we had a balance of 20,900 as per our sales ledger, but we forgot to include discount that we have given to our customer, basically a trade discount, which is 200. So if we reconcile this into our balance, then my balance will decrease from 20,900 to 20,700. So this is your correct option. Question number 8. At the year end, Victor had 100 units of inventory, which had cost him $12 per unit. Okay, he has 100 units and the price is $12 per unit. Of this, 8 unit has been received on the last day of the year and had not been paid for. An additional 6 units were damaged and would be sold for $10 each once repairs to them totaling $20 were made. What was the value of inventory in Victor's financial statement for the year ended? Okay. So if you see here, there are 3 pieces of information is given. We have 100 units for $12 each. Out of this, 8 were given to us, or we received it at the last day of the year. Okay, and from there, 6 units were damaged and can be sold only for $10 if we incurred additional cost of $20. Okay, so the question is, what is the value of inventory we should write in a statement of financial position at the end of the year? Okay, so let's do the calculation. We have 100 units of $112 each, so 1200 for this inventory. Okay, but out of this, 8 units has been received on the last day of the year and had not been paid for. Okay, so we have not paid for it. Okay, but still this is our inventory, which we should be including in our stock. But from this, 6 units, okay, can be sold only for 10, that means 60. Okay, but we need to incur additional cost of 20. Okay, so that means if I subtract 6 units from here, if I subtract 6 units from here, which would give me 94 units, okay, my total will change. Okay, now in that, I will get, for those 6 units, I'll get $60, but I need to incur loss or the repair cost of 20. Okay, so that means it is 1168 should be the value of your closing inventory. 1168. So 1168 should be the value of your closing inventory. Number 9. Okay, in income statement, which one you will write down as your expense? Accrued wages at the end of the year. Okay, so accrued wages which you did not pay should be considered as your expense. Okay, as per matching concept. Prepaid telephone charges at the end of the year. So this is the prepaid for next year, upcoming year. So we will not include that as this year's expense. And increase in provision for doubtful debt. So provision for doubtful debt is increasing, so we should be including this as our expense. Okay, so the option that says both of these are correct is your right option. So it is option number C. Question number 10. At 31st December 2021, the draft statement of financial position for the business shows total assets of 1 million. The following was then discovered. An increase in the provision for doubtful debt 5% had not been recorded. Closing inventory had been overvalued 20,000. A depreciation of 10,000 had not been recorded. What was the correct total assets value? Okay, so in this question you need to understand assets equals to capital plus liabilities, okay, which is as per our accounting equation. So if your total assets is 100,000, then your capital and liability together is 100,000. Okay, so let's say this is my capital and liability, which is 100,000. Now if your capital or the liability decreases, your total assets will also decrease. Okay, so in the question it says An increase in the provision for doubtful debt 5,000 had not been recorded. So there is an increase in the provision for doubtful debt of 5,000 which we did not write. So that means if you increase the provision for doubtful debt of 5,000, your total trade receivable will decrease by 5,000. So we can say that trade receivable is decreasing by 5,000, so your asset decreases. Okay. Subsequently, your capital will also decrease, or your profit for the year also decreases. So 5,000 is decreasing from here as well. Next is closing inventory had been overvalued by 20,000. So inventory is an asset, is increasing by 20, it's overvalued by 20,000, so it will decrease the value of closing inventory, but subsequently it will also increase the cost of sales and decrease the gross profit. Okay, so which will decrease your capital later. And then the last one is depreciation of 10,000 had not been recorded. So there's a depreciation of 10,000 which you did not write. Okay, stop. So there's a depreciation of 10,000 that you did not write down. So if you write down this depreciation, then the value of non-current asset will decrease by 10,000 and your profit for the year will also decrease by 10,000. So now we can say that the total value of assets is, did I say 100,000 or 100 million was the amount? Oh, sorry, 1 million. 1 million was the amount. One more zero here. One more zero here. Okay. So we know that both the sides are matching. 965,000. 965,000 is our correct answer. I hope you understood this sum.